Imagine building an entire business, pouring years of your life into mastering this really complex skill, and then discovering that sending a simple introductory email to a potential client is actually a punishable offense.
Right. It's wild to think about.
Yeah. Or like finding out that handing someone a business card that accurately calls you an expert could literally get your license suspended.
Exactly. I mean, we live in a world where we are constantly told to hustle, right?
Oh, constantly. Build a personal brand, shout your achievements from the digital rooftops.
Always be closing.
Yes. But there is an entire profession out there operating under rules that make the standard modern hustle completely illegal.
Welcome to today's deep dive. I'm your host, and I'm joined by our resident expert to look into exactly that.
Glad to be here. And yeah, it really sounds counterintuitive to, well, everything we're taught about surviving in today's economy.
It really does. So for you listening, today's deep dive is into the professional ethics and liabilities of auditors, specifically the Chartered Accountants Act of 1949, which I know sounds like an audio textbook waiting to happen.
Right, a dense manual from 1949. But the mechanisms inside this text are actually fascinating. We're going to crack the code on two notoriously strict rules today. Clause 6 and Clause 7 of Part 1, Schedule 1 of the Act.
And our mission here isn't just to memorize a list of don'ts for an exam. We're looking at the underlying philosophy, right? Like, why do these invisible ethical boundaries even exist?
Exactly. And how they actually function when they crash into the modern reality of, websites, networking events, and the internet. Plus, I promise you won't have to rely on rote memorization today. We've got two really vivid mental hooks to make these dense legal clauses permanently stick in your mind.
The underlying why is really the key to all of this, because on the surface, these rules just look like archaic handcuffs.
Yeah, they really do. So let's start with Clause 6 of Part 1 of the first schedule.
Right, so Clause 6 lays down this uncompromising core mandate. It basically states that a chartered accountant, a CA in practice, is guilty of professional misconduct if they solicit clients or professional work directly or indirectly.
Any kind of solicitation.
Any kind. By a circular, advertisement, personal communication, interviews, or, frankly, any other means. You simply cannot ask the public for work.
Okay, looking at the text here, I can't help but notice that the number 6 is shaped exactly like a fishing hook.
Oh, that's a good way to look at it.
Yeah, so mentally, for you listening, this is the fishing hook rule. Clause 6 means you are legally banned from casting a line out into the public ocean to try and hook some business.
That is a perfect way to visualize it. The hook must stay in the tackle box.
But why? Like, why is the fishing hook so heavily regulated?
Well, the manual provides a really brilliant piece of context right at the beginning. It outlines this scenario where a CA completely overlooked major glaring errors in a client's loan account.
Wow, on purpose.
Essentially, yes. This accountant basically helped hide non-performing assets from a bank. And the reason he did it was because the clients promised him more work in the future if he, played ball.
Ah, the classic conflict of interest. He was so desperate to secure and keep that client that he just compromised the entire audit.
That's the core issue. A CA has a unique fiduciary duty. They aren't just working for the person paying their invoice, they're actually acting in the public interest.
Right, because shareholders, banks, the government, they all rely on the absolute objectivity of that audit.
Exactly. If CAs are out there aggressively competing and fishing for clients, the power dynamic shifts. The accountant becomes desperate to please the client.
And the temptation to bend the rules to win or keep that business just becomes dangerously high.
Right. So the ban on solicitation is basically a mechanical firewall. It's designed to protect the CA's ability to say no to the person paying them.
Okay, I understand the noble intent there. The firewall makes perfect sense for public trust. But practically speaking, if I'm a newly minted CA, I have rent to pay. It's like a bizarre dating scenario where you are forbidden from making the first move. No ads, no cold emails, no pitching my services. So how do I survive?
Yeah.
I can't just sit in a dark office and hope someone magically senses my accounting aura, right?
No, you don't have to do that. The Act does account for that reality.
Okay.
You can't cast your line into the open ocean of the general public, but the source text carves out a very specific, protected ecosystem.
What kind of ecosystem?
Well, a CA is explicitly allowed to apply for, request, invite, or secure professional work from another chartered accountant in practice.
Ah, okay. So it's a closed ecosystem. I can't fish in the ocean, but I can fish in the CA pond.
The CA pond, yes, that's a great analogy. The CA pond is safe because another chartered accountant already understands the ethical boundaries, right? They know the nature of the work.
So if an established firm has like overflow work. A junior CA can absolutely write to them and offer their capacity.
Exactly. That B2B, or rather CA to CA communication, doesn't threaten the public interest. The established firm still maintains the primary insulated relationship with the end client.
Okay, so fishing in the CA pond is perfectly fine, but that brings up a massive issue. I mean, this act was written in 1949. That was an era of print circulars and physical letters.
Very different world.
Yeah. Today, we live in a digital economy. If I set up a website for my firm, isn't that essentially putting up a global digital neon sign? Anyone in the world can stumble upon it. How does the fishing hook rule apply when just existing on the internet feels like indirect advertising?
It's a great question, and the friction between that 1949 hook and the modern internet was a major hurdle.
I bet.
The text actually highlights a specific case study to demonstrate how the Institute of Chartered Accountants of India, the ICAI, adapted to this.
Oh, let's hear it.
It's the case of a firm we'll just refer to as MSXYZ. So this firm created a website, xyzindia.com, and they populated it with details of their firm, partner bios, and passport-size photographs of the partners.
Wait a minute. In any other industry, that's just the bare minimum of existing as a business. But under Clause 6, I'd imagine that triggered a massive red flag. I mean, they're putting their faces and credentials out to the general public.
It did trigger scrutiny, but the ICAI introduced a really critical distinction to resolve this. They looked at the difference between a pull mechanism and a push mechanism.
Pull versus put.
Right. They ruled that a CA firm can create its own website functioning as a passive directory. That's a pull mechanism. Someone has to actively search for you to find that information, much like, looking up a number in a physical phone book.
I see the distinction. A passive directory is just saying, hi, here is our address and here is our educational background.
Yeah.
But if that same website had a giant flashing banner saying, voted best tax savings in town, call now for 20% off, that crosses the line.
Exactly. That's a push mechanism. That is casting the fishing hook.
Got it. So it's a fine line between existing and selling.
Right. And the M's XYZ firm was cleared of misconduct because their website stuck strictly to facts, bios, and photos. It was a digital phone book listing, not a billboard. The intent is really what matters there.
Let's push that line a little further then. What about government work?
Okay.
Because governments and large state departments, they don't just use phone books, they issue massive public tenders. You have to actively bid against other firms to win that work.
They do.
And a lot of times, you have to pay a deposit just to submit a bid.
Yeah.
So how does a CA bid for a tender without violating the rule against soliciting or, paying for work?
The guidelines address tenders specifically, and the text uses the case of a firm named M's LMN to explain the mechanics here.
Okay, what did LMN do?
So this firm responded to a tender from a state government for a really massive project, the computerization of land revenue records.
Sounds like a huge job.
Oh, yeah. And to even be considered, the firm had to pay a 50,000 rupee earnest money deposit.
Wait, paying 50,000 rupees just to bid? That sounds an awful lot like paying to secure work. Which is illegal, right?
On the surface, yes, it looks bad. But the ruling hinged on this concept of exclusive versus non-exclusive areas.
What does that mean?
An exclusive area is a service that only a chartered accountant is legally permitted to do, like a statutory corporate audit. In those areas, the rules are incredibly rigid. You cannot pay to play.
Okay, that makes sense.
But the computerization of land revenue records, that is a non-exclusive area. An IT firm, a consulting agency, or a management firm could also bid for that exact same job.
Ah, I see the logic. If the CA firm isn't allowed to pay the standard earnest deposit, they're completely locked out of the market. They'd be at a massive disadvantage against, IT firms who aren't bound by the CA Act.
You've hit the nail on the head. Because the work was open to other professions, the CA firm had to be allowed to compete on standard commercial terms. So paying a reasonable earnest deposit for a non-exclusive tender is perfectly legal.
Oh, it's...
Yeah, the LMN firm was cleared. The board noted they would only intervene if a firm paid an exorbitant deposit that clearly looked like a bribe.
Wow. Okay, so we know you can write to another CA firm in the pond, you can have a passive website, and you can bid on non-exclusive government tenders. The boundaries seem pretty clear. But what happens when someone misunderstands these mechanisms?
Well, that brings us to a rather tragic case study in the text. It involves an accountant. The source literally names Mr. Honest.
Oh, no. You can already tell this isn't going to end well for him. What did Mr. Honest do?
Poor Mr. Honest. He was a practicing CA and he was really struggling to build a client base. He was hungry for work, so he took action. First, he wrote 2 letters to another CA firm, politely requesting they allot him some professional work.
Which we know is totally fine. He's fishing in the CA pond.
Right, perfectly legal.
Hmm.
But then he went a step further. He wrote a letter to a non-CA organization, a company the text just calls ABC, asking them for professional work.
Oh.
Yeah. Another CA found out about this approach and reported Mr. Honest to the ICAI, and the ruling was swift. Mr. Honest was guilty of professional misconduct.
But wait, why is writing to company ABC illegal if bidding for a government tender is allowed? Both are non-CA entities, right?
True, but it comes down to the mechanism of roving inquiries versus existing panels.
Explain that.
Many large organizations like government departments, courts, or major banks, they maintain an official known roster or panel of chartered accountants, and they use this panel to distribute work.
Okay.
The explanation to Clause 6 explicitly states that if a CA knows a specific panel exists, they are totally free to write to that organization and request to have their name added to the roster.
So you can apply for a job that officially exists.
Yes. What you cannot do is make blind roving inquiries. You can't just spam random organizations essentially saying, hey, do you need an accountant? That is the definition of casting your hook into the open ocean. Mr. Honest didn't apply to an existing panel. He just made a blind, desperate grab for work at company ABC.
That is heartbreaking. The tragedy of Mr. Honest. Undone by a misunderstanding of the fishing hook rule, he spammed instead of applying.
Exactly.
Okay, so we've thoroughly covered the mechanics of how you were allowed to find the work thanks to Clause 6. But let's say I navigate the CA pond, I set up my passive website, and I successfully land a client. That leads us directly to the second major regulation we need to decode today.
What you are legally allowed to call yourself once you get the job.
Right, which brings us to Clause 7 of Part 1 of the first schedule. And if Clause 6 was the fishing hook, Clause 7 makes me think of James Bond. 0007.
I love this hook.
Yeah, think about it. For you listening, when someone asks James Bond what he does, he never gives a marketing pitch. He doesn't say, I'm a highly synergistic international espionage consultant specializing in crisis management.
No, he definitely does not.
He is rigid, precise, and completely devoid of fluff. He just says Bond, James Bond. And Clause 7 dictates that a CA must treat their professional identity with that exact same level of unadorned precision. Their answer is essentially accountant, chartered accountant.
The 07 rule is a brilliant shorthand for this. Clause 7 is all about strict identity borders. It mandates that a CA cannot advertise their professional attainments, and they cannot use any designation or expression other than chartered accountant on their professional documents, visiting cards, letterheads, or signboards.
Zero fluff allowed. But wait, what if I actually hold a completely valid specialized skill? Say I've spent 20 years optimizing corporate structures. In any normal industry, I put management expert on my business card.
Sure.
It's just smart branding. It tells the client exactly what value I bring to the table.
Well, in the world of the CA Act, that smart branding is a fast track to disciplinary action. Yes. The source material actually breaks down this exact hypothetical scenario. The only exceptions to the 007 rule are if you hold a degree from a legally established university, or a title indicating membership in another professional institution officially recognized by the central government.
Yeah, let me guess. Management expert doesn't fall into either of those categories.
It does not. It is a self-awarded marketing title. The text outlines a scenario where a CA gives a speech, refers to themselves as a management expert, and then hands out visiting cards with that title to the audience.
Okay.
The text notes this results in a severe double whammy.
A double whammy. Let me think about the mechanics of that. Okay, first, by printing management expert on the card, they violated Clause 7 because it's an unapproved, fluffy designation.
Yep.
They broke the 007 rule.
That's one.
But wait, if they're handing those cards out to an audience after hyping up their skills in a speech, and that's not just an identity issue. That is actively soliciting clients. They just cast the fishing hook.
You deduced it perfectly. It's a double violation. They violated Clause 7 with the fake James Bond alias, and they simultaneously violated Clause 6 by using that alias to solicit work at a networking event.
Wow.
The rules literally interlock to prevent any form of aggressive self-promotion.
The rigidity of this identity rule is just fascinating. But surely there must be some wiggle room for related financial fields. What if I'm also a cost accountant? That's
Yeah.
a real valid field of finance. Can I put that on my letterhead?
The text is explicit on this as well. A chartered accountant in practice cannot use any other designation than that of a chartered accountant on their primary document.
Even if it's true.
Even if it's true, even if you are a cost accountant, it is considered improper to use that as your primary designation. The 007 rule is absolute.
That is so strict. What about something as basic as firm culture? Every modern company has a mission statement. Something like, we strive to synergize global accounting paradigms to empower your financial future. Can a CA firm put a simple mission statement on their letterhead?
Absolutely not. Mission statements, vision statements, they are completely banned from letterheads, visiting cards, and general stationery.
Because a mission statement is essentially just a disguised advertisement. It's boasting about your firm's attainments and goals. It adds fluff to Bond, James Bond.
Exactly the reasoning. Now, the guidelines do state that a firm isn't forbidden from having a vision statement entirely.
Oh, they can have one.
Yes, it can exist in a specific, detailed firm profile. However, that profile can only be provided if a client specifically requests it. You cannot just hand it out freely or print it on your everyday correspondence.
It's like you have to keep your firm's personality locked in a vault until someone explicitly asks for the key.
Pretty much. And the text even mentions rules about passing exams.
Wait, really? Something as innocent as putting a notice in the newspaper to celebrate passing a certification.
Yes, even personal success is heavily regulated. If you or a candidate in your firm passes an examination and you want to publish a notice in the press, it must be a pure factual statement.
No bragging allowed.
None. It cannot contain any element of advertising. You cannot use your exam success as a subtle backdoor to remind the public how elite your firm is. Every public interaction must be stripped of promotional intent.
Man. So let's bring this all together for you listening. We've decoded these dense regulations using two mental hooks. First, when navigating how a CA acquires work, you have Clause 6, the fishing hook. You cannot cast a line into the public ocean. No ads, no aggressive pitching, no blind roving inquiries to random organizations.
Right. You must restrict yourself to the CA pond, passive directories, and official existing panels.
And second, when establishing your professional identity, you have Clause 7, the 007 rule. Accountant, chartered accountant. No embellishments, no self-awarded expert titles, and no mission statements on your business cards. Your identity must be presented with absolute, unadorned precision.
Spot on.
So why should you care about this? I mean, unless you're currently studying for an accounting exam, why spend time unpacking the rigid anti-hustle regulations of 1949?
Because it completely reframes how we think about professional trust. When you hire a high-level expert, whether it's an auditor looking at your company's books, a lawyer handling your estate, or even a medical specialist, understanding these invisible ethical boundaries gives you a tool to evaluate their true integrity.
That's a really profound point. If a professional is perfectly willing to break their own industry's strict code of ethics just to get your attention,
Exactly.
if they're out there acting like a billboard when their rules mandate they act like a phone book, it begs a very serious question. If they cut corners on their own ethics just to win your business, what other corners are they willing to cut when they actually start doing your work?
And that's exactly why the restrictions are there. They aren't there to stifle business. They are a structural guarantee. They ensure that the person auditing your financials is motivated entirely by accuracy, objectivity, and the law, not by a desperate need to retain you as a client. The refusal to hustle is the ultimate proof of their independence.
Which brings us to a final, somewhat provocative tension to leave you with today. We've seen how the entire credibility of this profession relies on its stubborn refusal to aggressively market itself. It's a badge of honor. But we are moving rapidly into an increasingly noisy, highly digital world.
We really are.
We are entering an era where AI can do the basic math, generate the reports, and balance the ledgers in seconds. In a near future where the technical work is commoditized, human branding and personal connection often seem like the only differentiators left for professionals.
And the pressure on these traditional codes of ethics is only going to intensify as technology evolves. The friction is real.
So as you go back to a business world that constantly demands you shout your achievements from the rooftops, consider this. In an economy where attention is the ultimate currency, and AI is leveling the playing field of hard skills, how long can a profession truly survive by refusing to market itself? Will the silent integrity of 1949 be enough to keep the chartered accountant relevant in the reality of 2030?
It's a tough question.
It is. Something to mull over. Thanks for taking this deep dive with us today. We'll see you next time.